Hello, everyone, and welcome to our Altos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich. We have Craig Ward with us here tonight in the chat. We're really excited to have you guys with us here tonight. We've got a lot of great information to go over. This is your first time on. You'll notice that your microphones are muted. That's so we can all hear Jeff talk. But we do have a Q&A box, so if you have any questions tonight, just feel free to put those in the Q&A box, more so than the chat, and we'll see those and answer those throughout the evening. If you have to hop off for any reason, don't worry. This is recorded. It'll be available in the members area later tonight and posted tomorrow on YouTube. So if you're watching this on YouTube, please like and subscribe so you can get more of our videos that we're shooting out every Tuesday. Before I bring on Jeff, let me just read a disclaimer. Altos Trading LLC and Trade Trend / Zillion software is intended to be used as information service for subscribers and includes opinions as to buying, selling, and holding various stocks and other securities. However, publishers of Altos Trading, Trade Trend, Zillion software are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber or in view of the particular circumstance of any particular person. Altos Trading, including its owners, do not accept responsibilities for any decisions made by subscribers using the software, and subscribers to the Trade Trend Zillion software or any other persons who buy, sell, or hold securities should do so with caution and consult with a broker or investment advisor before doing so. So with that being said, Jeff, let me get you on here.
Hey, everybody.
How's it going?
Good. Let's start with a quick poll. Does anybody notice anything different about Richard? See if anybody gets it.
Like he's still fat.
Hey, PK.
What do we got? He looks paler than usual. Got nothing, man.
Nancy says, looks like Richard. Yeah. Keith and PK got it.
I had to do it, man. The beard's been like a little while. My daughter wanted me to shave it. She's 6. She's about to turn 7. And she was like, Daddy, you always scratch my face when you give me kisses for nighttime. So I said, you want me to shave it off? And she's like, yeah. So I shaved it off this morning before I took her to school. And I came out here and she's like, put it back.
You're not my dad.
I know. You look like my daddy, but a different daddy and scary.
Well, I think you look 10 years younger.
That's what my wife said. She's like, I kind of like the old look better, but
yeah.
What are you gonna do?
Him says my daughter did the same.
Yeah, she just thinks it's too pokey. Daddy, you're pokey.
Well, looks good.
Appreciate that. So what's going on with you?
Oh, ready to kick off a good session tonight. We have, I think, a really fun thing to talk about, and I think it's I think is going to be relevant to what's going on in the markets, and we try to make the topics obviously timely and relevant to the market conditions. So I hope it is, and so yeah, I'm excited about tonight. I think it's going to be give you guys a lot of value, and after we do our market overview and recap and look at the 36 month moving average, we're going to talk about how to protect your trades with options collars. Just out of curiosity, has anyone on tonight heard of a collar or ever used a collar? Option collar?
I can't think of you ever talking about option collars in 5 or 6 years.
Yeah,
I can't think of once we've talked about.
Ray says all the time. Ed's heard. A lot of people have heard of them. Ray's the only one that's used them. I'm going to show you a twist on it. So there's collars can be really good. Ed says he's used it once, but there's a downside to them, just like there is with so many option strategies. But I'm going to show you kind of a really cool way to overcome that downside. So that's going to be our topic tonight, new strategy for you guys. But I think it's good for current markets because obviously we've got all this volatility, coming back into the market. We've got, the right now it's around, the Fed meeting in Jackson Hole. So they have this big symposium every August, and a lot of times it just kind of goes unnoticed by the general public, but it's a hot topic this year, of course, because Everyone's on the edge of their seats to see what Jerome Powell is going to say about inflation. So that's a lot of what's driving the volatility this week, and also the sell-off that we've seen in the last couple days. So I think this is a really good strategy for if you have a long portfolio or a 401k or IRA. Although you couldn't do this in your 401k, but we can talk about how you can still use the strategy to protect a 401k without being able to do the strategy in your 401k account. So it can be used for protecting long positions during periods of market volatility, but it can also be used as speculation. So if you're purely a short-term trader and you don't hold long positions in your portfolio, what I'll show you and demonstrate can be used for speculative trades as well. So it's pretty cool stuff. And then it might take a little bit of time, and so if we get to the ticker roundtable and have time for it, we'll do that. But if not, we'll leave more time for next week there, and then we'll wrap up with Q&A. So I'm going to try to get through our market overview, kind of quickly here. Let me turn my video off. And I think we've all been following the markets right this week, and from following up from what we talked about last week, we had this area of resistance on the S&P that we mapped out kind of more as a resistance zone. So if you were on last week, you'll recall that we were talking about how this was probably going to be a difficult zone to break through, and we could see a sell-off from the zone. So we've seen that. So we called that one correctly, and we had also mapped out some support levels. And we're just coming down into one of those support levels around 41.25 that we mapped out last week. So you can see that we did this all ahead of time last week, and how accurate price has reacted to these zones and levels. So it sold off from there, came down. So it looks like we're finding some support around 41.25. We closed just above that today on the S&P. So that's one we're going to really want to watch for tomorrow to see if this 41.25 level holds as support. And if it breaks, to what magnitude do we get a close below the level? And then if so, we would mark it as a resistance level with a potential retest and sell off. I'm fairly hopeful and optimistic this level will hold, and we'll move back up off of it. But we'll look at the VIX and see what it's telling us. But these are the zones and levels to really watch this week. So keep an eye on this resistance zone, because now it's stayed resistance because we sold off from it. So if price does come back up, we still could find some resistance here, kind of between 42.50 and 43.25. All right, so that's the S&P. And let's take a look at the Qs for the NASDAQ. All right, so also we had mapped out these levels last week. This was a support last week around 320, but it was broken yesterday. And so now we have two closes below. And then we had mapped this 335 to kind of 340, 345 zone. All right, so you can see there's the sell-off from this resistance zone that we mapped last week. So these zones have held as we projected. So a bit of a difference here between the NASDAQ and the S&P. So S&P were closed above a strong support level today, and it held. But on the NASDAQ, we broke a fairly strong support level yesterday. So kind of watching around the 310 to 300 for a support zone on the NASDAQ ETF, the Qs. All right, so this is our support zone. And this was support, but is now a resistance level right around kind of 320. So since we're moving away from this resistance zone or resistance level that was support, we're watching for price to find support at this next, the top of those support level, but possibly, within this support zone. So I project that 300 will likely hold if there's any continued sell-off. Usually with these, this is kind of a fear-based sell-off. So, or we could maybe call it an uncertainty sell-off, because until we have the full picture of, the comments and statements that Jerome Powell is going to make at the Jackson Hole symposium, that I think that fear will subside and pump more liquidity, buying liquidity into the market. So if we do get some continued sell-off this week, I think that the support levels on the NASDAQ and the S&P will probably hold, and we'll see some buying off of these support zones. But definitely a potential to continue, the downward spiral, so to speak, that we've been in a little bit more. So we'll likely, continue to map these similar levels depending on where price ends up at the end of the week. But the VIX is giving us, some good clues as well. So remember, we always look at the majors like the NASDAQ and the S&P in relation to what the VIX is doing. And last week, we emphasized the 20 level on the VIX, right? That we had come down from prior resistance into the 20 level and found support there. And remember how last week we talked about we had come down into this 20 support level on the VIX, and we were hitting resistance on the S&P and the NASDAQ simultaneously. And so that's how we projected this rotation lower in the markets since our meeting last Tuesday. So that's sure enough happened. So you can see these can be very reliable and accurate levels and ways to identify potential turning points in the markets. So we have bumped up against a 25 resistance on the VIX. So this is now, and I'll kind of highlight where the VIX often finds resistance around this 25 level or support. So since we bumped up against that yesterday, and we've kind of stalled and had an inside day where the high and low range of the VIX today was within the previous day's high and low. So there was consolidation and volatility contraction. So less volatility today. And we're getting a stalling around resistance while we're seeing a stalling like around support on the S&P as we looked at. So that could be a potential turning point back to the upside, but we need to wait and see whether, in the coming days, tomorrow and through the rest of the week, the VIX, maintains this 25 resistance level or breaks through it. Because if it breaks through it, then we'll likely see a rotation lower in the majors and the S&P and the NASDAQ. So there's more resistance. If the VIX gets up to, 28 to 37, I don't think it has a very good chance of getting up to 37, because again, this is brought mainly an uncertainty sell-off. And once that uncertainty and fear subside, volatility tends to come down. And that's kind of starting to happen right now. So, those are the major levels on the VIX. So again, support here. That's the one we mapped out last week. This week we are hitting resistance. So this is really the key level, around 25 to watch for tomorrow and through the rest of this week. So what we'd like to see is for the VIX to hold this 25 resistance so it doesn't break through and starts to retreat back down to 20. And if we can see that happen simultaneously with S&P and NASDAQ holding support and moving back up, that's our clue that the recent sell-off is potentially reversing back to the upside. All right, and then let's look at the 36-month moving average on the monthly chart. We've been watching very closely. So we still have a little more than a week left in August. So we don't want to, it's not set in stone yet. We don't want to jump to conclusions, but a little bit concerning the price action. So this is a monthly chart of the S&P. Little bit concerning in terms of, oops, let me. Price action for the month, because it found resistance again around this level that we had looked at previously on the monthly chart. So see how this month we came up? That was right up into the 43.25 quarter century mark. So we had a rejection of that roughly 4,300 zone. And we had several months of selling pressure below that zone with closes above. Then when we finally broke through, it then, that support, there's the support from 2021, came back up and retested it. So see how we've got this rejection of this 4,300 resistance zone now. So that's going to be the big one to break through for this 36-month moving average pattern to hold. Okay, so this is our resistance. So I think short term, that's going to be our challenge to the upside. For medium to long term, if over the next few months and certainly through the end of this year through 2022, if we can stay above the 36-month moving average, that's more medium to long term bullish. And I think medium to long term we'll see continue to see a move to the upside off this 36-month moving average as we had in past mean reversions or tests of that average. But based on price action so far for August, we may have a pullback or even a retest of that before that happens. So also really important to watch the 36-month moving average on the monthly chart.
Yeah, it looks like there's not like a ton of follow through on it. Like it kind of,
yeah.
The other channel.
Yeah, totally. But remember, the month's not over, and what's possible here is that because we had this selling, because of we got it, to that resistance level, but then we had selling pressure because of the uncertainty around this Jackson Hole meeting symposium. And again, once that kind of subsides, we could get more buyers coming in. So it's very possible we could still get a strong close by the end of the month, higher up on the range. But it's gonna be, at least through this week or into early next week, because the last trading day of the month is next Wednesday, a week from tomorrow. So we've got another week of trading for us to really probably get clarity on that. Yeah, Shoba, I use the 36-month on the major indices. So not just the SPX, but also the INDX. And we can take a look at that also, but it looks similar. So as long as this, and I'm just going to call it 12,000 because it's a millennial mark, and it's even though it's a little below the 36-month moving average, which is at 12, right, currently 12,194.38. But interestingly, this, we'll just call it 12,200, lines up almost perfectly with prior support here, prior resistance. You can see all of these months where price is reacting there. So that's what we call confluence. There's a confluence between a horizontal static support level and a dynamic moving average, support level or moving average. And it's right here at about 12,200 on the NASDAQ. But similar to the S&P, you can see this resistance level from the month. But again, month's not over, so, but you see that. You can see it's just really incredible. Even, you're doing this so many years that you're looking at this and how markets react so precisely around these levels or even moving averages. But historically, especially the last two tests of the 36-month moving average on the NASDAQ, we got a lot of buying off of that. And I think we'll see that again. And it's just going to take a little bit of time to play out. Might not happen as quickly as it did, back in 2019 or 2020. But you can see how far off we got, how far away from the mean we got. And so this is a great tool to use to tie this into our topic for tonight, using an option collar to protect long trades. If you're long the market, and I'm starting to kind of set these up on my long positions, on like the SPY and the Qs. If you're along the market and you're getting far away from the mean, that's usually when it can make sense to hedge a portfolio, and the option collar is one way to do that, because you just become more likely eventually price will revert back to the mean. It's an inevitability. So it's going to eventually mean revert back to the 36-month moving average. So risk in the market is high when price is far away from the average. And even though it takes a sell-off, a correction, or even a bear market to get us back to the average, and that's when people think there's high risk in the market, that's really when risk is lower. After these mean reversions occur, or there's a market sell-off or a bear market or a correction, it's too late to protect yourself at that point. So the protection really needs to be done when markets are at higher levels. And most people do that, unfortunately, in the opposite. They don't have the protection there, and we can't predict market sell-offs. We know that they'll happen, that they're inevitable, but we don't know exactly when they'll happen. So that's why I think it's we're going to start go, and we've looked at the ratio back spread and some other ways to hedge and speculate on these types of directional moves. But I think it's important, especially if you have an IRA or a 401k or a retirement portfolio, to use these strategies to protect to the downside. And there are drawbacks to hedges, right? If you hedge, to some degree, it's going to add some risk and limit your upside potential. So it's really important to look for ways within strategies to limit that and overcome it as much as possible. And that's what we're going to look at tonight. You really can't create a perfect hedge that to a point where the hedge doesn't actually become the risk, or it's, in other words, negates having a long position. So it's not about creating a perfect hedge. It's about protecting, against downside risk as much as possible while still allowing for upside potential. And then one other thing real quick, I wanted to look at is just the gauges in sector performance right now. So our algorithms have a high ratio of sells to buys right now. Trend is still somewhat in the mid-range, but to the bearish side. Risk has peaked with the recent market sell-off, kind of in the mid-range. Most sectors are underperforming. So communication, tech, consumer discretionary are leading the sell-off. Energy is really the only sector right now that's doing well in this sell-off. So if you're looking for buying opportunities, right now, the energy sector is the place to be. And if you're a Zillion user, you can just click on the top performer, underperformer, and immediately get your energy stocks in your scanner and look for buy signals. Or if you want to short or implement bearish strategies on underperformers, you can select any of the underperforming sectors and look for sell signals. And what I like to do is I like to look for the sell signals that line up with a bearish divergence cloud. Right now, there aren't any in the energy sector. We're just looking in communication sector, just looking in communication. You could look in tech. Not in tech at the moment. Consumer discretionary. So we don't have anything lining up sell-wise within a cloud. So then I would look for underperformers sell signals that aren't in a cloud. So there's no bullish or bearish divergence, or buy signals that aren't in a cloud. No, But right now there are a lot more bullish divergence clouds because of the run up we've had in the market the last couple months. So we're starting to see the bullish divergence kind of fade, along with the run up in the market and then the sell off. So just something to keep an eye on. Let's see here. Okay, so I want to pause there, see if any questions, Richard, and then we'll get into our strategy.
Okay, let's see. I'll show a couple of comments. Keith was saying, thanks for the overview of the indices and VIX. Helps me put into context my contrary and continuation trade ideas. Smiley face.
Oh, good.
Let's see. This is kind of a segue for into tomorrow, but it says, it looks like when we were looking at NDX, it looks like a shooting star candle pattern. And he was saying, do you look at candles?
Yeah, I think that was on the monthly chart.
Yeah, it was.
Yeah, so I do look at kind of the sentiment of the candle in the context of the support and resistance level. So like a shooting star that's not off of a resistance level really wouldn't hold a lot of weight for me. This one is, but also I look at it on a closing basis. So being this is a monthly chart, I wouldn't make any decisions off this type of candlestick pattern until it's fully completed in this, on a monthly chart, in this case, at the end of August, or on a daily chart, at the end of the day, because we never know where it's going to end up, right?
Yeah, he was just saying it was on the monthly and the daily and a few other indexes also. But I was going to say that there is somebody that we know that's kind of one of the king of candlesticks, and we're supposed to be hosting him tomorrow night, guys. So I don't know if you guys have seen the emails we've been sending out, but we're going to have Stephen Bigelow, candlestick genius that he is, to kind of come through and talk to us tomorrow. So we invite you guys to come out and do that. We talked about last week about having a someone we do an interview with during our live session. He had so much to say, we wanted to kind of give him his own spot. So tomorrow we're gonna have him join us, and I'm gonna post a link in the chat so you guys can kind of register for that. And if you can't make it, it'll send you a copy of the replay.
Yeah, Steve's really great friend of ours, and expert on candlesticks. Certainly more so than I am, and free event. It's free to attend. So yeah, I hope you guys can make it tomorrow night. What time is it, Richard?
8 Eastern.
8 o'clock Eastern. So yeah, Richard put the link in there for you guys so you can check that out. He'll be here with us tomorrow.
That's like Jeff just posted. The cloud is essentially an indicator of divergences. Please say a simple explanation of what it is.
Yeah, that's right, Jeff. It's so a red cloud is bearish divergence. Green cloud is bullish divergence. So it's an algorithm that was developed by Daniel Sinning and his team at tradingindicators.com. So it's proprietary to the Zillion platform. And basically, when we see price in a green cloud, in particular, when we see a transition from a red to a green cloud, it's telling us that there's a divergence between the momentum algorithm and price. And more often than not, when we see that divergence occur, in terms of bullish divergence, price goes up, and bearish divergence, price goes down. So it's for me, it's a great tool to kind of filter out opportunities. So as an example, like I would mainly look at like taking a sell signal or a short trade in a red cloud, and maybe avoid, even though like there was a nice buy signal here. It was actually it was out of a cloud. It was in between the two red clouds, but like some of these buy signals may not run as much, while they're in bearish divergence. And so I try to take a signal that lines up with the cloud. And so like down here, as we shifted from bearish to bullish divergence, we started getting some buy signals. These are ones that I'm looking at, taking that align with the cloud. So it's a really helpful tool, and again, use it kind of more as confirmation, and to help me kind of decide if I want to be long or short the market. I might be more likely to take like a sell signal after a green cloud outside of the cloud, or a buy signal also outside of the cloud after a red bearish divergence cloud. But I don't use it as a standalone decision-making tool. It's more confirmation. It just kind of helps me filter and also scan for opportunities. Like for instance, like if we're hitting resistance on the major indices and the VIX is starting to spike, that's kind of the first step in my top-down analysis approach. So what does that tell me? Well, I'm going to, if I want to trade with the broader markets, I'm going to want to look for short opportunities. So then I might, look for sell signals within bearish or red divergence clouds. So that's kind of part of the process.
Gotcha.
Yeah.
Makes sense. That's all I got for now.
Okay. So let's talk about, thanks for those questions, guys. Those were good. Let's talk about the options collar. So I'm going to give kind of a high level overview of what it is. I know not everybody trades options, and not everybody on the session might be very, real proficient with options, but I'll try to give a, kind of high level overview of what it is, how it works. And then if you have questions, please ask, because I want to make sure everyone is tracking and no one gets left behind. So I'll kind of start by explaining, let's just pick a stock. So let's see, let's find ourselves a stock to look at. Back over here. Let's just look at the energy sector. All right, and let's look at Halliburton. All right, so I just ran a quick scan. I picked energy because it's the only positive performing sector. I just happened to see that there was a recent buy signal that was triggered today on Halliburton. And I know just from experience, Halliburton is an optionable stock. So we can use this as an example. All right, so Halliburton is broken out of this tight range that it's been in since early July, right? So strong breakout candle. The stock closed up almost 7% today. Let's say that I wanted to, was considering buying shares of Halliburton on, it already hit the trigger price, which was, let's see what that was. So the entry, because the signal came in last week, was at 29.96. All right. So it would have triggered just about right here. All right. So the trade's already in profit if I had bought on that signal, right? So it closed today at 31.22. But let's say I'd taken a trade off of this buy signal and got in around 29.96, the algorithmic entry, buy entry price. And I've got this, I bought shares of the stock, and I've got, this trade that's in profit. But there's a lot of uncertainty in the market. But there's volatility, creeping into the market. There's this, big Fed symposium that is probably going to create more volatility throughout the week. And I'm in a profitable trade. And by the way, I'm using this as an example. You could do this from the onset of the trade as well, but it's kind of the nice thing about it. There's flexibility to add this into even an open trade. So if you're already in a profitable trade, this is a great way to hedge and protect some of that profit in case the trade reverses on you. One of the biggest frustrations we have as traders and investors, right? You get in, things are going well, and then it reverses on you and wipes everything out. Well, the collar is a great way to protect against that using options. Let's use this as an example. So we'll pull up an options chain for Halliburton. And the best way to kind of start looking at what a collar is, because a standard collar involves both call and put options. Okay, so I'm just going to go out to the September monthly expiration. So 24 days out in expiration. So a put gives us the right, if we buy a put, to sell shares of a stock at the strike price that we select between now and expiration. It gives us the right, but not the obligation. We don't have to, but that's essentially what it does. So there's one of the most basic option strategies is called a protective put or a married put. And what that is when if you buy shares of a stock and then you buy put options to protect to the downside. So let's say that I got into, we'll just say we got, because the entry price from the algorithm is a little below 30 bucks a share, but let's just say we bought it at 30 bucks a share for simplicity's sake. All right, so if I wanted to not use a stop loss order, because there's problems with stop loss orders, right? The stock, what if something catastrophic happens and the market crashes overnight, and I wake up in the morning and Halliburton crashes with the market and it's trading, let's say down at 25 bucks a share or something. And I had a stop loss order in at 30 bucks a share, which is my entry price. Well, it doesn't matter because the stock gapped down and you couldn't do anything about it. So that's where the advantage of options can come in. If you bought a 30 strike put, it doesn't matter how that stock could go to zero. And between now and September 16th, you can sell your shares of that stock at 30 bucks. It gives you that right. And for that, you pay a premium. And in this case, these contracts are offered at $1.14. So if we bought 100 shares of Halliburton, we would need to buy one put contract to protect those shares because every contract controls 100 shares of stock. So we bought 1,000 shares of Halliburton, we need to buy 10 30 strike puts to have the right but not the obligation to sell our shares between now and September 16th at 30 bucks a share. So it's like insurance, and we're paying a premium for that, right? So it's $114 a contract. So if you bought 100 shares of Halliburton, it would cost you $114 to protect it at the 30 strike. So it costs money, right? And there's a problem with that. And that is, when we talked about volatility skew, and you'll see how these weekly sessions really start building on each other. We talked about volatility skew in past sessions, and there's huge volatility skew in Halliburton. What does that mean? If you look at implied volatility, you'll see that the out of the money strikes, in other words, the strike prices that are far below the current stock price, the volatility is going up. They're trading at much higher volatility than the at the money strike price. So the 31 strike has 52% implied volatility. But if you go out to like the 25 strike, that's a huge difference. It's over 7% volatility skew. So what does that mean? Well, it means these options are actually, even though the price is lower, relative to the protection you're getting at that strike, they're actually a lot more expensive. Not on a nominal basis, but on a value basis. So the higher the implied volatility is kind of a good way to think of it. The more that the more expensive that insurance is on a value basis. So like if you're out shopping for car insurance, right? You might shop around a few different car insurers to get the best rate. Well, that's how options work, right? You want to pay the best price for the protection you're getting, right? Because you might have a higher premium at one car insurance company, but you may have a lower deductible and more protection. And so options, it's a good way to look at options like that too, because when implied volatility is high and there's volatility skew, you're probably overpaying for the option and the protection. Now look at the there's volatility skew between call and put options. So these are our put options that we were looking at. These are our call options. So the call option gives us the right but not the obligation to buy a stock at a certain price. So if we buy a call at a 32 strike, between now and September 16th, we have the right to buy those shares at 32 bucks, regardless of where the stock goes. And we, again, pay a premium for that. But look at the implied volatility on the call side. If we just look at the money, right? Let's look at the 31 strike. 52% on the put side. Same strike price, 49.5% on the call side. Same strike, same expiration. What does that tell us? There's more demand for puts because they're more expensive and they're in higher demand. So always look at the volatility skew, because what do we want to do as traders? We want to buy low and sell high, right? Buy low and sell high. So that's, if you trade options, same thing. If you're going to sell options, you want to sell high implied volatility and buy low implied volatility. But the problem is, if you buy a protective put or a married put to protect shares of a stock, you're likely going to be paying a lot of premium for that. And in most cases, you're going to overpay. So it's expensive. So how do we overcome that? Well, that's where the collar comes in. So what a collar is it takes that protective put. So let's say we buy the 30 strikes because we bought shares of Halliburton, 30 bucks. Stock's moved up. It's trading at 31.22. We got $1.22 in profit on the position as of close today. We don't want to lose it. We want to protect it. But if we pay the premium to buy this protection, it raises the break even or profit level of the trade, because we have to pay money out of pocket for that. So it almost costs, and you're going to find this, and a lot of times it'll cost more. In this case, it does cost a little less, but 114 bucks per contract. So 1.14, and we have 1.22 in profit. So we're using almost all of our profit that we've made in the stock so far to buy the protection. So we need the stock to go up even more for that protection to really be a financially sound decision. See what I'm saying? So we're going to buy insurance. It's going to eat up almost all the open profit we already have in the trade if we just do a protected put. So it raises the break-even point in the trade, and the stock has to go up that much more for us to make a profit, because it has to overcome the premium that we would spend to buy the puts. So what the collar does is it attempts to overcome that, and it does it. This is where it ties into volatility skew. It does it by selling into volatility skew, taking advantage of it. So see on the call side, here's implied volatility. See the skew? See how the further out of the money strikes have higher implied volatility. And what do we want to do? We want to buy low and sell high. So we want to sell higher implied volatility to bring in more premium. So what the collar does is it combines a protective put. So we would buy the put, right? And simultaneously sell a call at a higher strike to finance the cost of the put. All right, so let's say, let's see here. let's say, now here's the trade-off here. So when you sell a call, you are then obligated to sell the shares at that strike price at expiration if you still hold the short calls and the stock is trading above that strike. So let's say Halliburton continues to go up in price. And let's say we sell a 33 strike call. Okay. So when we're an option seller at the 33 strike, we collect a premium for that. So we're paying a debit for the puts, but we're collecting a credit for the calls. But let's say Halliburton keeps going up, the stock keeps moving up. And let's say by September 16th, it goes above $33. Let's say it really takes off and it goes up to, let's just say $40 a share. Well, unfortunately, we've obligated ourselves to sell our shares at $33 because we sold calls. So we're selling that right to the option buyer to buy those shares from us at $33 a share. Okay, so we'd miss out on this whole $7 price appreciation of the stock if we did a collar that way. So that's the downside of a collar. The plus side of it is it can bring in premium to help pay for the puts and offset volatility skew. But the downside is it limits your upside potential at whatever strike you sell the calls. You can go further out of the money, or in other words, a higher strike price on the call side, but you're going to bring in less premium and finance less of the cost of the puts. So that's the trade-off. That's trade-off number one. Trade-off number two is you cap your profit potential. You can only make on the shares where, between where you bought them and what the strike price of your sold calls are. So that would be $33 in this example. So we bought at 30, we sold calls at 33. If the stock shoots way up and goes above 33, and we hold the collar through expiration September 16th, we are obligated to, those shares are going to be called away from us automatically by the broker. They're going to be sold from your account. And would you have made money? Well, let's see. You made $3 on the shares, right? Bought at 30, sold at 33. You paid $1.14. Okay, so you lost $3 of that profit on the stock. Out of that $3, you lost $1.14. But you also brought in $83 by selling the calls. So if you had not set up the collar and you just bought the stock at 30, sold it at 33, you would have been better off than having the collar, but the collar gave you downside protection. And we defrayed that cost to some degree by selling the puts, with the trade-off being that we had to sell the shares at $33, assuming the stock trades above 33 at expiration. So we cut into our $3 per share profit a little bit, but we also gave ourselves protection, because even if the stock tanked, the market crashed, something happened at Halliburton, and the stock crashed, we had the right to sell those shares back at $30 no matter where, even if the stock went to zero by expiration. So that's the collar. And I'm going to show you in just a second how to overcome this limiting the profit potential, because that's the real downside of the collar, is that you're limiting your upside. And the less you limit your upside and try to, overcome that, the less you're going to get paid for the call options because you're going to have to go to a higher strike. And you can see as you get higher up here, if we try to sell a 40 strike call option and give ourselves $10 of profit potential on the stock, we would have only collected $5 to pay for $114 of insurance. So it becomes less, effective the higher in the strike. That's the trade-off that you're going to encounter. So we're going to overcome that with a bit of a twist on this collar trade. But I'm going to pause and see if anyone has any questions or don't want to leave anybody behind.
Let's see. It's not here really trying to soak it in, but I think it's a lot of people are saying definitely a good strategy in certain markets at Shoba. Yeah, I think for some folks, they've probably never seen a collar before, so they may have to watch this piece over again.
Sure. Yeah, absolutely. That's why we record these, because it's a lot to take in, and you can rewatch this as many times as you need to. And we'll, as we do with other strategies and methodologies and things in our sessions, we'll continue to build on this. So these, sessions are intended to build on this. And if you missed the volatility skew session, for instance, you'll want to go back and watch that because it'll help you understand kind of the rationale behind this type of strategy.
Yeah, Stephen just asked, do you buy the put and sell the call at the same time and same date of expiration?
Oh, great question. Generally, I will buy the put first. So, different platforms allow you to do things differently. You can certainly do a collar trade and execute it simultaneously on Thinkorswim. Some platforms you have to, build the trade with individual legs. So if that's the case, I would typically, buy the put protection first, and then go ahead and then sell the call. So you're going long the put and going short the call second. Buying the shares first. So that would be like, step one is buy the shares, step two, buy the put, and step three, sell the call.
Ed asked, consider doing an option risk reversal presentation also in the future. Not sure how to do one in toss. So maybe that's up for another day.
Yeah, we've done the risk reversals in past sessions. We have recordings of those, but we're going to build on those more too. We'll do those in subsequent weeks as well.
Do you think some people get themselves, they try to say offset the entire cost of that put by selling more than one contract of the calls? Is that
all right? Now,
idea to do?
Yeah. So now, who asked that?
Me.
Oh, nice job. You're hired. Yeah, you're on the right track. So that's kind of what we're gonna look at, but a little bit, that's not the whole thing. So yeah, so if you were just to do that with buying a put for protection and then selling a one strike call, there you would take on a lot of risk by increasing the number of call contracts that you sold, because what Richard's saying is, like, if you pay $1.14 for the 30 strike puts, and you want to give the shares more room to run for upside potential, which means you're gonna have to go to a higher strike price, and the premium that you'll collect for selling those calls is going to be less. A caller, you do 1-to-1, right? So if you bought 100 shares of stock, you would buy one put contract and then sell one call, right? So you do one put for 100 shares of stock. So you did 100 shares of Halliburton. You bought 100 shares of Halliburton. One put, you buy one put, and then you sell one call, right? So 1-to-1, because each contract controls 100 shares of stock. So if you were to sell two calls, instead of bringing in $57, you would bring in $1.14. Hey, that would perfectly cover the cost of these puts. But what did you do? You added unprotected risk to the upside on the calls, because once you went above that one contract, because you only own 100 shares of Halliburton, you now have one naked call in your portfolio. That's your exposure now. And naked calls are very risky. They have unlimited risk. If the stock goes up, that one extra call can lose unlimited amount of money to the upside. So it would, not only would most people not have the options approval to do that in their account, it would add a lot of risk if you do. But it's still on the right track. So here's the way to structure this so that we can overcome the limited upside potential of the standard caller. All right, so nothing changes on the put side. We still buy the 30 strike put for protection. All right. But rather than selling a single strike call, we sell a call spread. So it's a credit spread. So you still collect a credit for the trade, but your downside on the call spread is capped. So remember, when you sell a call by itself, it's unlimited risk. It's not in the case of a caller because you own the shares, but that naked call can lose an theoretically unlimited amount of money because the shares can go up theoretically to an unlimited higher price. So there's a call credit spread. And remember, this is again is where volatility comes in, involves selling one strike and then buying further out of the money strike. And that caps the risk and the loss potential on the call spread while still bringing in a credit. And it allows for the unlimited profit potential on the shares of the stock that you own. But in order to do that, we need to do it at a 2-to-1 ratio. Oops, not the right drawing tool. We need to do this at a 2-to-1 ratio. So for every one put that we buy, or every 100 shares of stock that we own, in other words, we would sell 2 call credit spreads. So you don't have any unprotected naked calls. You've got a call credit spread. You're bringing in credit at a 2-to-1 ratio, and you want to try to do it for roughly. You want to sell this call credit spread and collect a premium that's roughly equal to what it costs you to buy the puts. So it takes a little bit of like kind of trial and error to figure this out. There's no real perfect formula for it. You just kind of got to play around with the strikes and the premiums. So like, again, this is once we own the shares. So remember, we bought shares of, in our hypothetical example, bought shares of Halliburton at $30 a share for $114 a contract. All right, so we want to collect about $114 from the call credit spread to finance the cost of these, because they're expensive, because we've got all this volatility skew. So we want to start kind of playing around with the strikes to see where we can, what we can do to collect that at a 2-to-1 ratio. So what I would do, let's say, remember, we're not capping our risk at the strike anymore, because if the stock zooms up to 40, my risk was capped on this call credit spread. So it doesn't limit my upside like the standard caller does. So, let's see. Let's look at these 33s. Let's say we sold a vertical. So if we sell 33s and say we buy the 36s, let's see what that brings in. So you're gonna have to kind of play around with the widths and the strikes here. But you'll know you've set it up correctly if at a 2-to-1 ratio, so we're going to be doing, so we're buying one put contract, we would have 2 contracts in our spread. And we want to bring it about $114. So this is going to be a little too much, but just went a little over. That's pretty close. So we collect $118 for this credit spread. All right. So what that means is if the stock goes down, I can still exercise my puts and sell the stock at 30, and I'll keep the premium from the call spread that I sold. So it basically gave me free protection if the stock drops, right? Whereas if I didn't sell this call credit spread, if the stock drops, then it cost me a lot. It cost me quite a bit of money. All right, so we could actually, this one kind of worked out. You want to make sure you're just barely paying anything for this, or barely paying anything for the whole caller. So your credit from the spread, the debit, wanted to be kind of done for close to same price. In this case, the way that I set this one up, selling a 33 strike call and buying a 36 strike call, 2-to-1 ratio, 2 contracts to every 1 put option, would give me a little bit of a net credit. Because remember, the puts cost me a $1.14, and I'm collecting a $1.18, 118 versus 114. All right, so our risk on this is capped. So if the stock zooms way up, it's not limiting my upside potential on the stock like the standard caller was with just the 1 strike sold call. So that's where this overcomes that drawback to a standard caller, while still setting up a similar type of protection and overcoming volatility skew and the high price you pay for protected puts. And still keeping our risk capped and under control.
It's interesting. It's kind of like a smarter alternative to the old diagonal collar strategy we used to teach.
Yep. Because yeah, so let me just delete this out. Let's say we just sold the 33 strike call. What's our maximum loss potential? Infinite. We will lose money on these calls infinitely as the stock goes up. Now, since we own shares of the stock, that doesn't mean it's protected from that ownership. They're going to get called away from you at that 33 strike if the stock again goes up to say 40. So it's not like you're in the context of the caller, you're taking on infinite risk. This is only if you just sold the call. But point being, what it does is it caps your upside risk on the shares of the stock at the strike price you sell the call. Whereas if you sell a call spread, like we just set up, right? So I can reset that up. right? Then our risk is capped at 482 bucks. So if the stock shoots way up, we just overcome that drawback of selling a call. This can also be used for covered calls. So if any of you trade covered calls, if you have long stock in your portfolio and you sell calls against the shares for premium, why not sell a call spread, right? Because you can still collect a credit. It might not be as high, but you're not limiting your upside potential as like you would be if you just sold a call, a covered call. Because the loss on that spread is capped, and the potential appreciation of in the price of the shares of the stock is unlimited. So that's kind of the deviation and different version of a collar that is very not at all widely known and very underutilized. Go ask 10 of your trading buddies or investors if they know how to trade that variation of a collar. Ask 100 of them. I bet you won't get one person that does.
So there's a question that came in saying, just to confirm, do you need to have 100 shares of the stock before implementing this strategy? Then you would buy one put and then sell a call spread to finance the put.
Yes. Yeah. So here, I'm going to kind of write out the steps. So step one is you would buy the stock. Okay. And in this case, we did, Halliburton at $30 a share. Oops. All right. So again, depending on your broker platform, you might be able to do this in a single order, but if not, this is the steps I would do it in. Execute. So we buy the shares of the stock. And again, this can be done when you all at the onset when you buy shares, or if you've already got a long portfolio and it's gone up in value and you want to protect profits, you can add this collar to open stock trades if they have options that trade on them. So step two is to buy protective puts, and you do one contract per 100 shares of stock, because each contract controls 100 shares of stock. Step three is to sell a call credit spread. And this is the part where you'll kind of have to play around with the strike prices and the width of the spread at a 2-to-1 ratio. So that's 2 contracts in your spread for every 1 put contract. Okay, so that covers the cost of the puts. So that's kind of the steps you would do. And again, each contract controls 100 shares. So, if you did 500 shares of stock, if you bought 500 shares of Halliburton, you would you would buy 5 puts and you would sell 10 contracts in your credit spread. And that's where you play around with the strikes and the width of the strikes to get that to be, if you set it, you'll know you set it up correctly. If you have kind of a slight credit or a slight debit in the overall position, or about, try to do it for about even money, where the credit that you bring in from the credit spread covers the cost of the puts. So you have to adjust the number of contracts in this collar trade to match the number of shares that you bought.
That's cool. So somebody asked kind of in the example, like with this, let's say you had it like it was where you're going 2 to 1, you bought it at 30. If Halliburton goes up to 40, and you had two contracts that you sold for your call spread, I think it was a $482 max loss on that.
Hmm.
You make $1,000 on your shares, and then you subtract out what the 482 that you would have had to have lost plus or minus any sort of little credit or debit you would have had from the put difference.
Yep. Yeah. So you
Okay.
see, so you make more if you had just done the standard collar and the stock goes up to 40, you made more with this version of the strategy
Right.
because it didn't limit your upside. Yeah, that's exactly right.
But if it had gone down, then you pretty much financed the cost of your protection and you made money as it dropped.
Yeah. So it provides the benefit in the other direction or too. Exactly.
Yeah.
Yeah.
Interesting. Let's see. Is there like a downside if, like, let's say the stock doesn't move much at all, up or down?
Good question. Yeah. So, there's obviously a lot of different possible outcomes and ways to manage this. So if the stock just kind of stays where it is, also a benefit because your call credit spread will expire out of the money and your put protection won't be needed. So basically you just protected, so you would lose the money you paid for the puts, but you would keep the money you collected from the credit spread. So basically you had protection on during the life cycle of that trade, that collar trade. That reminds me, I want to mention one other thing. So in our example, we looked, come on, 24 days out. So for those 24 days, we had protection that turned out we didn't need, but we didn't pay anything for it. We kept the credit. We lost the debit from the puts, kept the credit from the credit spread. No harm, no foul. But if you'd done a regular collar or just a married put or protected put, you would have lost money on the protection. So it's also beneficial if the stock just drifts and stays sideways.
And M had a question. I kind of did too. Would it be more beneficial to go further out in time since it's your
Okay, great. So that's what I wanted to mention, and I forgot to. And
yeah.
Glad you asked that. So I think what I actually I didn't want to take that down. At your discretion, but I think that partly it's based on how long do you intend to hold the shares. So you want to some degree base it off of your outlook for the stock, because right, you bought the stock and how long do you want to hold on to it? How long do you want to tie up capital? How long, how far do you anticipate it'll go up? So this is where all of the other components of our strategy come into play, like resistance levels. Is there a nearby resistance level that I've mapped out that I might need to contend with? Maybe that's a good place to set my strikes. Maybe it's pretty far off and it might take, I anticipate it could take a month for the price to get up to that level. Well, if I think it's going to take a month for it to hit the next resistance level, I don't want to set up a collar 10 days out, right? So you kind of want to base it off the outlook of the underlying. But generally, I think to set these up, minimum 30 days to really, set them up effectively. And probably somewhere between like 30 and 90 days. I would say is a good starting point. As you get more comfortable with these and play around with them and kind of see how they work, you may find a different time to expiration suits you better. But I generally like to set these up, because I'm not doing and again, it depends if you have if you're doing this on your IRA or on a long portfolio. where you're really buying and holding, that's where I would do these, minimum 30 days and then maybe out to 90. So it takes very little management. If you've got an IRA account or you just, buy and hold stock or ETFs in your brokerage account, you could set this 90 days out and you only have to do this 4 times a year and just adjust it as you come around to expiration, right? Based on what's happening with the stock. Because I don't do, a lot of really short-term trading, but maybe you're more of a short-term, trader, and, you would look at a closer time to expiration. And speaking of retirement accounts, so you can do this in an IRA if you have options trading approval in your IRA. You can do this in, if you have options trading approval in your personal brokerage account, you can do it. Often get asked about 401ks because you can't trade options in 401ks, but most 401ks hold, long positions, right? They're in mutual funds or ETFs or a basket of portfolio of stocks. And unfortunately, you can't trade options in 401k. But if you hold positions in your 401k, who's to say you can't trade these options in another account, in your own personal brokerage account, against a 401k portfolio, right? So a lot of these strategies that can't be traded in 401ks, you can trade in separate accounts that have options trading approval, and you're just basically executing them in different accounts. So, money lost in the 401k can be gained in the personal brokerage account. It doesn't get the 401k tax treatment, but it could be done in an IRA. So you could, protect 401k positions in your IRA account.
Smart, man.
Yeah.
This is a question we might have covered it over, but is this true that this is best done in high volatile environments and not low volatile environments, or does it matter?
Good question. So that is the beauty of it. It's not the whole purpose really of this is, well, it's multi-purpose, but we're obviously trying to protect a stock trade without limiting upside potential too much. But it's also overcoming high volatility, buying high volatility, which is where options become expensive. So would I ever do a protective put, just simply buy a stock and put against it? Probably not. It's too expensive. Especially if you're really holding stock long-term. If you hold a stock in your portfolio, let's say I'm holding Halliburton, and I'm not even going a year out, I'm just going to April. It's going to cost me $425 for every 100 shares I own to protect this for less than a year. And what you'll find, the way that these options are priced, they're usually priced pretty close to, it's hard to overcome the premium basically. So in that time frame. But that's a lot, 425 is a huge percentage increase in the stock, right? It could happen, but what if it doesn't? What if it stays flat or goes down by next April? Then you just lost all this money that you paid for the puts. So why not sell a call credit spread against it, finance it, and you're still giving yourself, unlimited upside potential without limiting that profit potential as much as if you just sold a call against the shares or just bought a put or did a standard caller and bought a put and sold a call.
That's awesome. I think you guys definitely watch it over again. Felt like it was coming too fast that you just rewatch it. I think you'll definitely get it. It'll kind of click for you. And I mean, like Jeff said, it's something that's going to work, in all markets and to give you that protection. It's a beautiful thing. being able to have protection at pretty much no cost with, you're protecting your downside and, you're still not fully limiting your upside. That's pretty darn strong.
Yeah, and if you weren't in attendance or haven't done so, watch the volatility skew lesson that we did a while back. Can't remember what month that was in, but
I'm gonna look for it now. Somebody else asked about it earlier.
okay. Yeah, it's on our YouTube channel and in the members area, but that'll help you understand too, because to answer that question a little bit more detail, you're selling the higher implied volatility because we have the volatility skew on the call side. So you're selling a call credit spread. So you're selling high IV implied volatility to overcome the high IV implied volatility on the put side. So that's.
Yeah, it shows like a month ago. Let me see if it's got the exact day. July 13th.
Okay, so yeah, back on our July 13th session, we went over a volatility skew more. So that'll kind of help you understand the benefit of, how volatility skew works and the benefit of, selling higher implied volatility and buying lower implied volatility. But I think the car insurance analogy is a good example to help kind of understand that.
Sweet.
Well, we didn't, we ran out of time for our ticker roundtable, but we'll do that next week. Any final questions? If you guys think of anything after our session tonight, you can email us support@altostrading.com. And otherwise, any final questions before we wrap up?
No, so a lot of people had a lot of, I think it definitely got the wheels turning for a lot of people. So we'll probably have more questions about it next week as people watch it and let it all kind of sink in. And don't forget, guys, we're doing a bonus session tomorrow night, Stephen Bigelow. And I'm gonna post that link in here one more time. I should have waited till the end earlier.
Yeah, guys, definitely recommend joining tomorrow night. I think Steve's teachings definitely tie in well with the strategies we're talking about as well. Thank you, Chris. Appreciate that. Yeah, Steven. So the call credit spread, you're selling an out of the money call and then buying a further out of the money or a higher strike price call. Same number of contracts. Exactly right, Steven. You got it. Yeah, thanks so much, Chris. All right. So Richard has put the link for tomorrow night's session. Again, complimentary. Steve Bigelow will be joining us and teaching some cool candlestick patterns and tricks, which I always learn something from him. So I'm excited to be on that tomorrow night as well.
Yeah,
so I hope to see you guys there tomorrow, 8:00 Eastern. And thanks everybody for the great questions and participation. I hope you got a lot out of it. We'll have the recording up in the members area tonight and on the YouTube channel tomorrow. So hope you guys have a great rest of the trading week, and we'll see you all next Tuesday.